Hello, my name is David and welcome to David Computes. In this video we'll be looking at how to read charts. These charts could be a stock chart, could be a foreign exchange pair chart, could be a commodities chart, a futures chart, a crypto chart. They all can be read the same way. So we'll start with the basics and build from there. So at the very basics we have an horizontal axis that gives us the time and a vertical axis that gives us the price. So on this simple basis we can start marking prices into this chart. Let's say we've choose the close. So at the end of the day, for example, we check the closing price for let's say a stock and we mark it there. Then next day we repeat the process, we get a second point, let's say goes up, and carry on third day, fourth day, and so forth. And then when we have collected our data, we can obviously connect all these dots and we get our first chart. To this type of charts we call it line charts. This is the most basic stock chart that you can have. This is very common and easy to find in all software platforms, websites, you name it, it's always available. This is the most basic that you can see. This is an example I have here. This is for the Standard & Poor's 500 futures. This is the E-mini futures contract, but it's just for you to have an idea. You can see on the horizontal axis we have the time. So in this case it's like N starts at the 20th June all the way through July and then beginning of August, and then we have on the vertical axis we have our prices. So looking at this chart that we had before, what else could we do to get a bit more information? Because obviously we have the time progressing there, we have our closing prices, but let's say we actually wanted to get some more information. Let's say we wanted the open as well, we wanted the high of the day, and we wanted the low. So let's say we start marking the close, we would mark the open, we would mark the high of the day, and then we would mark the low. Now, this is all the prices for one day. We're talking in this case, for instance, for one day. So the low of the day, the high of the day, the close of the day, and the open of the day for our imaginary stock. So if we join this, we have a bar there. And then just to make the open and close a bit more easy to read, we've put some horizontal bars on the side. And this typical is what's called a bar. This is a bar. And if we had a collection of these, it would be a bar chart. This is very, very common. This is again another very popular way to represent data on a chart. So on a quick glance, you can see the open, you can see the close, the low, and the high. The low always being represented on the horizontal bar on the left side, the open always being represented on the horizontal bar on the left side, and the close always represented on the bar on the right hand side. So in this case, we could see the open was done at a price that is lower than the close, and then of course the high of the day and the low of the day. And the other thing is that we could also extract from this bar is the range, what's called the range. And the range is just the price range from the lowest of the day and the highest of the day. So that the maximum interval is called the range. And on charts, when we look on bar charts, it's always represented this. There's no dots at the high or close, so it's just a clean bar showing you the high, low, open, close. I believe that the bar chart is the simplest bar chart to read. It's pretty straightforward. A bit of practice, you start visualizing fairly quickly how a bar chart is represented. I'll be showing you some examples of this. But before, I also want to address something called a periodicity, or interval, which in the explanation I've given so far, I've been using the daily cases, but it could be used for other times. So it's just a different way. Sometimes people call it time frames, sometimes people call it intervals, and these can be in any time interval that you wish. You can have a yearly, you can have a monthly, weekly, daily. So I was giving examples before as on a daily basis, but you can have it on an hourly basis, on a 30 minutes, anything you can custom. You want 4 minutes, you want 5 minutes and a half. You know, a lot of software these days allows you to customize whatever time frame you want. So having the same example as before, let's say if we're considering a time frame of daily, so next day we'll have another bar. So in this case you can see that this was the open, that was the high, the low, and this was the close. And then the next day we have yet another bar. Again, you see here the open, the close, and then high and low. So each one of these bars represents 1 day worth of price movement. So during the day the price moved in this bar, the highest there and the lowest there with the open and close. Of course, be mindful that the bar does not give you any information on the price movement. You cannot say where did the price move. So when the price opened at the beginning of the trading day, you don't know if you went up first or if you went down first and then up again. You don't know if the high was done at the beginning of the day or at the end of the day or towards the end of the day, and the same for the low. So it doesn't give you any visibility within that time frame. So if you want to have a more granular view of what's happening, you always need to move into a smaller time frame, a smaller interval, to a smaller periodicity. So this is some examples. Here's again the Standard & Poor's E-mini futures chart. This is again a daily, and you can see different types of bars. Some with very big ranges like this one, some with very small ranges, some where the open price and the close price are very close together, others they're quite different, very different. With practice you'll be able to read these charts very easily without having to think twice about it. And the next is just a different representation. This is something, so the line's just thicker for easier visibility, and this is something that commonly is done where you color the bar to tell if it was an up day or a down day. When I say an up day, it means that the close was obviously higher than the up, so there was a gain, and you put it on green, it's easy to spot. Let's say then a red bar, which means you can see the open always represented on the left hand side and the close right hand side, and you can see that the close is below the open and therefore was a down day, and is represented by red. So this red green combination is often used, sometimes white black, so white for an up day, black for a down day. Again, you can use whatever colors you want, and these days with the software that is commonly available, there's a lot of freedom, a lot of flexibility on what you can do. But again, it's just an example of what you can have. So going back to our bar with our high, with our low, with our open close. If you try to think about this, what else could you add there? Is there any information you could add else there? Well, there was in the 18th century, the Japanese rice traders developed a different view of what is essentially the same bar. So in this case, they still mark a low, they'll still mark a high, but instead of having that little small horizontal bar on the left side and the right hand side, they basically extend it to both ways and then close it and produce this rectangle here. Obviously, one of the things you lose with this representation is where did the price open and close? Did it open here and close here, and therefore it was a down day, or did it open here and close there and it was an up day? So this is, although we do lose this information, there's obviously we can improve on this, but this is what's called a candlestick, the so popular way of visualizing data on a chart. So some people just call it candle or candlestick. So as I said, this was used back in the 18th century by Japanese rice traders. It only became popular in the West world much later. So if we analyze a bit of this candlestick, how can we differentiate what's the open close? So basically, the way it's done is by the color of this rectangular here. That I'll explain a bit better. So generally, if the open is lower than the close, means it was an up day, you generally color the body of the candle white or green. And if it's a down day, so the open was higher than the close, it opened here, then the price moved and ended up at the end of the day close, then you color the candle black or red. This is traditional. You can choose whatever colors, but it's a way for you to identify where the open is, where the close is. Is it an up day or down day? Furthermore, there's a common term used for these type of candles, which is a bullish candle. It is a term that is often, and it just means that it was an up day. If this was a daily candle, it was an up candle. And the explanation I've heard many times given about why is it called bullish is because of the movement that the bull does with the head as he horns, as he lifts the head from low higher. And similar when you have a down candle where the open is higher than the close, so it's a down day, you call it a bearish candle. And again, bearish because the way the bears attack with their paws, it's up, down. So opposite to bulls. That's the explanation I heard, and that's a common term that is used everywhere. So if you hear it now, you know what it means. So let's talk about a bit more this candle. There's a lot of names used to designate this. One of the things that you need to know is that upper bit there that goes from, in this case, from the close to the high, is called the upper shadow or wick. Of course, being called candle, it's a typical name. And of course, the bottom one will be lower shadow or wick. And then that rectangle, which I kept talking before, rectangle, it's called the body or a real body. So the body of the candle. Green, it was an up day. Red, it was a down day. Or if you're used to it, whatever color you want to define in your software. But this is just the default. So obviously the color, we can then know that the open was here and the close is here. Was this red? If the body of this candle was red, we would know that this would be the open and this will be the close. Again, with practice, it's very easy to do this without thinking twice. So here's an example of a chart. Again, it's the Standard & Poor's E-mini futures contract. And you can see here, this is a daily time frame. So each candle represents 1 day worth of data. So for instance, on this candle, you can see the price open here. It moved around. Again, we cannot say how he moved because that information is lost inside of the candle. That was the high of the day. That was the lowest of the day. And then the price closed there. And here we have a bearish candle. The price opened at this price, moved in that range from there to there. And at the end of the day, closed here. So a down day. And you can again see lots of different types of candles, some with very large bodies, others with almost no body at all. So if the open and close coincide exactly, you will have exactly no body. You'll just have an horizontal bar. And so this covers the very basics, will allow you to do a reading on a chart, and with practice this will become more second nature, will become easier and easier. But just before we finish this video, I'd just like for you to be aware that there's other chart types out there. We're not going to cover them, at least not in this video, but just for your awareness, I put a few examples here: the Aikin Hashi, the Renko, line breaks, point and figures, the Kajin range charts. There's quite a few of them. They're not so popular. The 3 charts I've covered before, the line chart, the bar chart, and the candlestick chart are the 3 most popular. And out of those 3, the candlestick chart is by far the most popular. And specifically the bar chart and the candle chart, perhaps more so the candlestick chart, is the basis for, well, famous candlestick patterns, which a lot of traders, investors use to make their decisions or to establish strategies. Obviously, these could be included under the technical analysis, which is a very popular subject. We'll not be covering this in this video. I want to keep it short and simple to help you assimilate these concepts. But perhaps will be the subject for a different video. But it's important to retain that built on top of this candlestick there's an entire universe, if you want to call it, of technical analysis, of which the candlestick patterns are part of. To finish this video, I want to thank you for watching. I hope you found this content useful, that you're inspired. And of course, if you have any questions, any comments, feel free to drop a message below or send me an email. I'll be more than happy to address them as I can.